We'll go ahead and kick things off today with a conversation about the White House's recent proposal of 50-year mortgages being a way to help homeownership affordability. Now, for some context, the median mortgage payment today in 2025 is nearly double what it was just 5 years ago. So will extending the payment reschedule plan significantly alter homeownership affordability? We are going to look at both the pros and the cons of something like this being implemented. First stop is going to be just looking at the math behind a 30-year versus a hypothetical 50. The loan amount, for our example, is going to be $350,000. The interest rate, we can take the national average right now, which is right around 6.5 on a 30-year. Now, we're going to do a little bit of guesswork on what that would look like on a 50. We do know that the spread between a 15 and a 30 is almost always going to favor the 15 in terms of what's going to be the lower rate, just because the longer you want to borrow money, the more risk that means for the lender. And in order to properly compensate them for that risk, you pay a little bit of a premium in terms of the interest rate. So if the 30-year right now is 6.5%, we're going to assume that a 50-year could be had for 7%. And when we look at what the monthly payment, again, same dollar amount being borrowed at a slightly higher interest rate for a much longer duration, what does that mean in terms of your monthly obligation? And we see from a 30-year obligation repayment schedule, we have $2,200 monthly payment. Once we stretch that out to 50, that drops down to $2,100. So we're looking at a roughly $100 difference between 30 and a 50. There is a segment of the population where that $100 difference is going to be the difference between them not being homeowners and them being able to qualify for a loan. So that is not nothing. However, for a vast majority of households, that $100 spread is going to be inconsequential. It does not matter. So yes, we're dropping our monthly payment by $100, but we're only helping a very small number of people. If the goal is to get more people to qualify for mortgages, there is going to be some small segment of the population this is going to help, but again, it's going to be extremely small. When you've heard conversations about this in the news, this is certainly going to be the most attention-grabbing part, is the total interest paid during the duration of the loan. So when we're looking at borrowing $350,000 for 30 years, the interest portion that we're going to pay if we were to hold the loan that entire period is right around $450,000. Where it really jumps out is when we look at it from a 50-year payback. That number jumps roughly $500,000 to $913,000, which is nearly $600,000 more than what we originally borrowed. So it's an extremely attention-grabbing, it's egregious. What I want to look at is not just that, but we're also going to take a look at what's known as an amortization schedule. And this is just how your monthly payments are applied every single month. So when you make your payment to your bank, part of that goes towards interest, part of it goes towards reducing your principal. Every month it changes a little bit. The further down the schedule you go, the more goes towards principal. I want to look at, from a 30-year perspective, we're going to look at what happens at year 10, because we can talk about 30-year loans, 15-year, 50-year loans. The truth is that the average loan only lives for a shade under 10 years. And what I mean is that people either sell their houses or they refinance their loan to get a better rate or a lower. So the average loan, even though it's scheduled for 30 or it's scheduled to 15, actually only lives for right around 8. But we're going to say 10 year at year 10, what does it look like? So we had a 10 years worth of payments. So we take the monthly payment, multiply it by 10 years, multiplied by 12 payments each year. At year 10, we have paid $265,000 towards our loan after year 10. And the amount of equity, so the amount of loan that we started with versus what we're left with at the end of year 10, $53,000. So we have $53,000 worth of equity in our home at the end of year 10. When we take a look at it from a 50-year, again, same dollar amount being borrowed, we have $252,000 worth of total payments. So a little bit less of total payments. However, our equity position, so the amount of house that we owe, drops to $11,000. So think about that. We've made $252,000 worth of payments to the bank at the end of year 10. And what do we have to show for that? $11,000 worth of equity. And when we take into account what we're paying for repairs and taxes and insurance, we're almost certainly in a negative position at that point. You could very well make the case after year 10, maybe you should have been a renter. Maybe it makes more financial sense if we only have $11,000 worth of equity. Maybe we should have been a renter. Now, if you happen to purchase in an area that is appreciating, so home values are increasing significantly, then the conversation shifts a little bit because, again, we're in this example, we're assuming zero appreciation. This is just how much of the loan we started with versus how much is left after year 10. So that's a little bit of a way to kind of look into it a little bit deeper in terms of not just what the total amount of interest spent is, because, again, these loans overwhelmingly do not see the end of their life. It gets paid off, refinanced, sold, however you want to look at it. But if you were to hold it for 10 years, $250,000 worth of payments gets you $11,000 worth of equity. Where the conversation shifts a little bit, because a lot of the coverage was overwhelmingly negative. It was very rare to see anything positive. One interesting way to look at it is, though, if you are one of the rare Americans that does hold on to their mortgage, so maybe 5, 10, 20 years into the future, rates just continue to go up and up, and you have this loan that you took out in 2025, your interest rate is very attractive versus what the market might be offering you at that point. Maybe you do hold on to it. You never move. You keep the same loan. Not a lot of people do that, but maybe you are one of the very rare. When we take a look at what the purchasing power of the US dollar is going to be doing, you could make the case that locking in a mortgage payment now and being able to keep that same payment for the next 50 years is an extremely powerful way to gain equity and take advantage of a US dollar that is continually going down and down in value. And what we might mean that is the average, what can you purchase for the American dollar? How much goods can you purchase? And when we take a look at, this is coming to us from the Federal Reserve, this is a graph of the purchasing power over the past 50 years. So for our 50-year mortgage, we're looking 50 years into the future. What has the US dollar done the past 50 years? And we see that the amount of goods that we're able to purchase is not only has it been going down, but it's going at an exponential rate. It's going down. So if we can lock in a payment today and hypothetically continue to make that payment, not just for 30 years or for 40 years, but up until year 50, that dollar we're going to be spending in year 40 and year 50 is going to have significantly less value than it does in 2025. So I think this is probably the best case to be made for why someone might be interested in a 50-year mortgage is if you don't intend to move, if you have expectations that interest rates are going to be significantly higher in the future, you're not going to be tempted to refinance. If you keep your loan, if you keep your house, and if you anticipate that inflation is going to be continuing at some rate and the value of the dollar is going to continue to go down, locking in your payment today could be extremely wise.